Your connection to the world.
Wall Street Week with Louis Rukeyser is made possible by the financial support of viewers like you and by Prudential-based Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. Produced Friday, July 28. Our panelists are Ralph Acampora, Frank Cappiello, and Louis Holland. Tonight's special guest is Ned Davis, President, Ned Davis Research.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week when we found out what the great commercial networks do when they can't find any legitimate news to report. They simulate it, or in simple English, they fake it. Did you see suspected Soviet spy Felix Bloch on ABC handing a briefcase to an enemy agent? No, you didn't. What you saw in grainy black and white shot through crosshairs superimposed on the screen to look like a genuine surveillance tape was what is politely known as a simulation. It was, in short, a phony. And Bloch, in fact, hadn't even been arrested, to say nothing of being videotaped in the act of subversion. Yet ABC, which these days apparently thinks any picture is better than having a reputable journalist tell you a story, apologized only for failing immediately to label the simulation as such. It didn't need a label. It needed Joe Isuzu, with a caption reading, "We're lying right now, but we'll get back to giving you the news in a moment." But let's not be harsh. This so-called simulation technique may have all kinds of wonderful new applications in the world of money. Some of them actually have been around for a long time. Did somebody give you rotten financial advice a few months ago? Never mind, he'll just simulate what he meant to say then. That technique is called writing a newsletter. And did some economist totally miss the course of the economy for years at a time? Not to fear. He'll just simulate the forecasting record he should have had. That is called being a professor. Now Washington can beat the media at their own game. Is the federal deficit an ongoing national disgrace? Rest easy. We'll simulate a balanced budget and put it on the 6 o'clock news. Tape at 11. Is Congress still talking political gobbledygook instead of economic sense about promoting savings and investment in America? Never mind, we'll simulate a sensible tax code and announce it on the Sunday interview shows. Maybe nobody will notice that it's labeled simulation. Happily, one thing that was for real this week was the stock market, finally wiping out in virtually every one of the broad averages all the damage that was done in 1987, before and during the melodramatic crash, and carrying those indexes to all-time highs. With only the widely watched but less representative Dow Jones Industrials as a conspicuous laggard, stock buyers rode an enthusiastic crest, powered by lower interest rates and the promise of more to come, and an economy that continued to slow down but not expire. We tonight will talk with one of the most deeply respected students of that market, and we'll offer some real, not simulated, analysis from a bunch of guys who never appeared in a faked videotape on a so-called news program, and whose other habits are good too. But first, let's check out the actual results on Wall Street, a place for which no printable label would truly tell the story. As noted, the Dow Jones Industrial Average hasn't yet quite joined the move to historic highs. But this week it came within about 87 points of doing so, and on accelerating volume. As the yield on long-term Treasury bonds dipped below 8% for the first time in more than 2 years, the Dow added nearly 28 points to 2635.24. As all the indexes advanced, as they have in every week this month, the New York, S&P, and Amex composites moved this week to levels higher than they had ever seen before. But it scarcely cheered our L's, whose technical market index is again bearish at -3. Gold was in retreat again this week, but never fear. Tonight we will at least be giving away some of our traditional golden nuggets to some outstanding letter writers. And not a one of the letters will be simulated. If you think it's getting risky to watch what purports to be the news on television, consider what other activities were found to be risky in a poll of Americans reported this week. 90% think it's risky to drive a car. And I'd just soon not be on the highway with the other 10%. But fully 56% think it's risky to mow the lawn. Remember that excuse the next time your spouse wants you to clean things up outside. Frank Cappiello, how risky is this market right now?
Well, we're a little extended, Lou. This market continues to push up with only a minor correction. So somewhere in here we'll get a correction, but there's a lot of power behind this market. Rates are falling. We had good news after the market closed. One major bank lowered its prime, so we can expect a continuation of that prime down to 10.5 next week. Transports are going to new all-time highs. That's very bullish. Commodity prices coming down in a downtrend. That's bullish for inflation, meaning inflation will be less. There's a lot of good fundamental rationale behind the market moving up.
Do you think we're not going to have that recession?
We'll have it. I just don't think we'll have it in the time span that all the experts predict. Certainly over the next, say, 9, 12 months, it's hard to see a recession with the momentum in this economy, even though the momentum is slowing, and the global economy that's expanding. What will put us in a recession has got to be an accident, something we can't see right now.
If we don't get one, maybe we'll simulate one.
Well, let's see if I can work something up, Lou.
Lou Holland, Frank says correction has to come at some point, but basically we're going to go higher. You agree?
Well, I think we're going to go higher also, even though I have mixed emotions on that to the extent that the market's up over 25%. I do think we're going somewhere over the next month or so, 2,700 to 2,800, but I do think we're going to have a meaningful correction as we go forward through some time or through some part of the summer.
Would you define meaningful for us?
Well, I would say we could have at least a 10% correction. I think if we go higher here, I think the chances of greater than a 10% correction become much more prevalent. I think it may be stimulated by the feeling at this point in time that a soft landing may actually turn into a hard landing, and that may come sooner than most people think.
There are two things that would normally put the stock market up. One is the idea that business was great and earnings were going to pour in. The second would be there's no other attractive place to put your money. Do you think that that's what's pushing this market up now, that as bond rates go down, that stocks become more attractive?
I think that has something to do with it. Obviously, there is the attitude with regard to takeovers. A lot of people want to be in there just to participate in one of those, so I think there's some of that. But I think lower interest rates has been a meaningful contributor to the advance we've had.
Well, if I compare these fellows talk about fundamentals, I know that doesn't concern you at all as a true elf and good technical market analyst. Tell us technically, is this market, to use Frank's word, extended at this point?
Yeah, I think a couple of words that we heard tonight, extended, is for sure the way to describe the market, and the word momentum comes into play. I think that's very, very positive. But, you know, it's the game that we all try to play is to call the next market correction. I don't think that's the game we should be playing. The thing that has worked so well in the last 8 to 10 months has been stock selection. And as long as I can still pick out good quality names that look like they have minimum risk and good upside potential, I think that's the emphasis. And right now, I can still come up with good quality names.
Well, let's do so immediately.
Yeah, well, a big name like IBM, this is a stock that everyone loves to hate. I think the worst is over for IBM. It's in the Dow. I'm not saying you can have instant gratification, but I think if you're a contrarian and willing to go out a little bit in time, that's a name. Another one in the Dow would be Eastman Kodak. They're underperformers, they're not overextended, and no one's talking about them, and I like them.
IBM not only is an underperformer, but it's scarcely above the level it was at right after the crash.
I think Dow is, I think IBM at the crash low was 100, and today's around 114, and Dow's over 50%.
If IBM does participate as a significant part of these averages, what does that do to your Dow prediction?
Exactly. That's where I think the Dow will get its kicker. I think not only will IBM do well over the next 12 to 16 months, but I think the psychology that would generate would cause the Dow to break 3,000 someday.
Quick technical question. The market had a very strong day on Thursday, had every right to back off today, Friday, didn't. Is that a good technical indication?
Yeah, I see technicians don't become bullish in the rallies. It's the failures that go down that impress us. And those stocks that I mentioned, the inability to go down is what impresses us.
All righty. Now, this is the point in the program when we usually pause for a round of viewer questions. Tonight, though, instead, I'm going to be singling out for special mention some of the best letters we've gotten and awarding to them our mildly coveted Golden Nugget Award. But we'll soon be back, as usual, to baser matters, so if you still have some unanswered questions about the world of money, just send them along to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, let's pause for a revival of an old Wall Street Week custom, the awarding of Golden Nuggets. From time to time over the years, we have presented these nuggets to viewers whose letters particularly amused, dazzled, or otherwise tickled our fancy. My first nugget tonight goes to Peggy Holmes, way up in Kenai, Alaska, who wrote me as follows. My husband and I have enjoyed your show for several years. However, I have a gnawing question. Many of your guests have a proven record of knowing what stocks to invest in, when to buy, and when to sell. If these financial wizards are so successful in managing other people's money, why aren't they independently wealthy and off playing golf rather than working like the rest of us? Well, Mrs. Holmes, I used to wonder about that myself. Why do these fellas sell or even give away advice in which they appear to have such absolute confidence? I guess they're all just sweet philanthropists, heartwarmingly eager to share their surefire wealth. Wonderful human beings, every one, and we should be humbly grateful, I guess. Sometimes, though, the benefits can be more tangible. For example, a number of Milwaukee viewers sent us clippings from the local paper telling of an elderly woman whose favorite television program, guess which, may have saved not just her finances, but her life. An 82-year-old friend's car crashed through her front picture window, where she normally sits, but happily she was in another room awaiting the Sunday morning rebroadcast of Wall Street Week. Now, that's a Wall Street crash a fellow can appreciate. But don't think you have to be over 21 to benefit from this program. Michael Windling of Belmont, Massachusetts, swears that his 20-month-old son, Jacob, never misses my opening monologue on Wall Street Week. This kid will clearly be among the great capitalists of the 21st century. Less bullish, though, is 1.5-year-old Luke Champlin, who seems in danger of being seduced by a bear. Getting out of the Kitty League, Eric Olson of Minneapolis claims that he discovered something bizarre about former Defense Secretary Robert S. McNamara while listening to his voice and patterns of speech on television the other day. After a couple of minutes, he says, I knew the reason. They belong to Julius Westheimer. Now, that's very perceptive, Mr. Olson. You notice you never see them talking at the same time. Our latest geography lesson comes from Poynette, Wisconsin, where Dorothy Rostel took this photo of the intersection of Wall Street and Pigtail Alley, which is certainly a hairy coincidence. I'm grateful, too, to the many viewers who keep trying to find a way for me to make a decent living in this world. For example, Sanborn Dow of South Burlington, Vermont, thinks I should open a new stock exchange for small investors only. Your viewers, who in general trust you, would welcome this opportunity, would pass the word around, and there you would have it, the small investors surging back into the market. It's a great idea, Mr. Dow, but meanwhile, I think I'll hang on to my day job. Donald Miller of Vallejo, California, may have a better idea. His grandchildren, Daniel and Katie, think there's a market for their Louis Rukeyser doll. And I think they're right, because who knows how many millions of frustrated investors might occasionally want to stick pins in it. Edward Batten of Toronto, Canada, on the other hand, thinks I may have a future in the newly restive Baltic states. He claims the name Rukeyser is actually Latvian in origin, and that it means, I kid you not, King of the Elves. I think this gives new meaning to Cole Porter's dictum, Lithuanians and let's do it. And finally, I'm grateful to Frank and Gail Whipred of Redmond, Washington, whose 11-month-old Springer Spaniel is registered with the American Kennel Club as Louis Rukeyser, Jr. And it's not because he thinks I'm an SOB either. It is, he assures me, out of love for you and your program. And isn't that a doggone good way to end this segment and go on to our next tale? So let's go over now and meet tonight's totally human special guest, Ned Davis. Ned, welcome back. Always a pleasure to have you. Please. Ned Davis may monitor more technical indicators than anyone in Wall Street, with the exception of our regular panelist, Marty Zweig, with whom he shares some business ventures. Already known as an elf's elf, Mr. Davis gained even more prestige when he advocated a heavy cash position before the 1987 crash, and then quickly became bullish after it occurred. His institutionally oriented firm in Nokomis, Florida, produces 8 different timing services, and last year generated more than $7 million in fees. Ned, so far this year, the market has shown somewhat more strength than you expected. Do you think we're at the end of the good news now?
Well, Lou, our forecast for this year was pretty much a bull market for the first half of the year, with a top in the midsummer and then going into a bear market. And we sort of thought the top of the market this year might be in the 2,500 zone, and that looked pretty good till July, when I just plain blew this last rally.
Well, we won't quibble with you over 100 points, but do you think we are at the end of the good news now?
Well, the market, my indicators, my forecast is bearish, but my indicators aren't bearish yet. And as a strategy move, what we've done is just told people to take enough money off the table to get into sort of a neutral stance. But we do see a lot of risks in the market.
Ned, you look at the market in terms of a number of different periods. Why don't you give us a short-term outlook, an intermediate-term outlook, and as far out as you want to go?
Well, as I said, I think basically we will make a top this summer, in the next few weeks, really. And I think...
But we're not there yet in your judgment.
Right. Close. I think the top probably is around the old highs on the Dow Industrials. And then I think we'll have a normal cyclical bear market as a forecast, I'll say 1990 and 1990. And which is about a 25% correction, which is normal for a bear market.
What makes you feel that we have to have that much of a sell-off?
Well, there's several key indicators that have had great records that are negative at the present time. And while you should never say never in the stock market, some of them have perfect records. One of them was invented by an analyst, technical analyst called Edson Gould, late Edson Gould, called the 3 steps and stumble rule. And he said anytime the Federal Reserve Board raises one of its 3 policy tools 3 times in succession, the market nearly always stumbles. This has happened 12 times since 1919. In every single case, the market stumbled. The average drop from the sell signal, which came in February this year, is 21% on the Dow Jones Industrials.
Even though we are now moving in the other direction, with interest rates going lower.
Right. We found, though, it takes 2 cuts in the discount rate to sort of do away with this, this 3 steps and stumble rule.
What would be your advice to investors right now?
Well, we're bullish on the bond market. We're very bullish on the inflation outlook and think the economy is going to slow quite a bit. And so I think high-quality bonds, government bonds, are a great place to put money right now.
As I mentioned, they've just dipped below 8% for the first time since the spring of '87. How low do you think that yield might get?
Well, we think at least another percentage point, which is 7%, which on a total return basis is a very nice return. Also, there's a lot of stocks that act like bonds, like utility stocks, some financial stocks, that we think also look good at the present time.
Any of those have names?
Well, seeing that I think the market has 25% risk in it, I'm going to sort of cop out like I did in '87 and tell you I just prefer not to get into specific names.
You wouldn't buy any stocks now?
Only stocks that like utilities, Pretty much. We have a model portfolio, even for our institutional clients. We only recommend stocks when the market's oversold. And we have only 3 stocks left in the portfolio. PepsiCo, which is soft drink stocks, which we like, Bank America in the banking area, and Sara Lee in the foods. And we recently got rid of Disney in the leisure area, which I like a lot as well, but we thought Disney was getting a little too popular a little early on that one.
You think if we're at 1990 and 1990, you must think we're going to be in a recession in 1990, do you?
Yes, here again, you know, the evidence just didn't in yet. The economy is doing fairly well. However, one indicator sort of sets me up and takes notice. We looked at the 9-month change in the M2 money, real M2 money supply, and we found that whenever it's negative 1% on a 9-month basis, we've always had a recession. This has happened 7 times in the last 40 years. The average lead time is 10 months, and this gave a signal in February of this year, a recession signal. So we think somewhere near the end of the year or early next year, we'll probably go into a hard landing.
I knew we were too cheerful tonight. Let's turn you over to 3 guys who may take some issues, starting with Frank Cappiello.
Ned, most of your work relates to historical precedent, relationships. And 2 of them I don't think are overpriced. One is price to book, but more importantly, price to earnings. They're not overpriced at the present time, are they?
Well, price to earnings ratios look cheap. They're last time I was on the show in '87, they were moving up towards 20 times, and now they're around 11 or 12 times.
Right.
So that's quite a difference. However, we have some problems with the earnings at the present time. Reported earnings over the last 3 years, S&P 500 have shot up 72%, and yet the Commerce Department has another series that they call real operating profits, where they take out phantom inventory gains and do proper depreciation, and they show that over the same 3-year period that the S&P is up 72% in earnings, real operating profits are actually down 9%. And our concern is that if in a booming economy, real operating profits are having trouble, what happens in a soft or even a hard landing? So even on the earnings standpoint, we have a few problems.
Ned, most technicians are viewed as people who read the tea leaves. Most individuals tend to concentrate on selecting individual stocks. How might individuals best use technical analysis?
Well, I think technical analysis has a lot of applications. Individual stock selection, as Ralph mentioned earlier, or overall market timing. And I think the main thing that I like about technical analysis is that it's by looking at the chart, you can get in harmony with the trend of the market or an individual stock, and I think that's a very important component in not making a major error.
Other than the 3 steps and stumble rule, what really bothers you on a technical basis? Is there another indicator that really concerns you?
Well, you know, the market is going up nicely. All the averages are in uptrends above their optimized moving averages. However, there are a few problem divergences. One of the most interesting ones that Lou mentioned earlier is that the transports have made new all-time highs by over 100 points, and yet the industrials are about 100 points below their all-time highs. I can't remember a divergence this striking except maybe back in the 1968 period. At that point in time, as you'll remember, a lot of people said, you know, the Dow Industrials are outmoded. They're just old fogey companies, and it doesn't mean anything. And the question, you know, was, this is the backbone of American industry, and what's the old man trying to tell us? And as it turned out, the industrials were telling us in 1968 that there was problems ahead.
What could happen that would turn you into a bull?
Well, if some of these divergences cleared up, for example, new highs made their peak in June, and daily new highs and have not confirmed here. The over-the-counter index has not made a new high. The utilities...
We should explain that. That's the number of stocks making a 12-month high price.
Right, 52-week.
Peaked in June and has not peaked at the time the averages were peaked.
Right, which shows that it's more of a narrow group of stocks going up this time. I think basically that the 2 problems, as I mentioned earlier, the 3 steps and stumble, which means the Fed would have to ease much more aggressively, and also on the money supply. I'd like to see the money supply growing, and quite frankly, I'd like to see values up a little higher, too. I think the market's getting a little pricey now. The S&P industrial average price-to-book value is at 2.5 times, and the only times it's ever been higher was 1929 and 1987, which turned out to be dangerous periods. So I'm not convinced the market doesn't have some value risks as well.
Let me ask you about a couple other areas. You've been bullish about the dollar. If you believe interest rates are going to continue to fall, are you still bullish about the dollar?
Yes, because basically our money supply growth has been so much slower than the rest of the world that we really feel like there's a shortage of dollars, and also the dollar on something economists call a purchasing power parity basis is still undervalued.
Means what it costs to buy a hotel room.
Right.
What it costs to buy a
around the
meal.
world, right, and ours is still cheap. And so basically, unless the Fed, until the Fed panics, I think the dollar's probably going to hold up pretty firm.
If you think the Fed's been so tight that a recession's a danger, if you think interest rates are coming down, am I fair in concluding that you don't think inflation is much of a threat right now?
No, actually, we've done a lot of work on inflation using the money supply, and we found that inflation tends to be about 3 percentage points less than money supply growth 2 years later. And money supply for the last 2 years has been growing around 4 to 5%, which would suggest, you know, incredible numbers like 1 or 2% inflation coming. So we're pretty bullish on the inflation outlook, and commodity markets made a new low again today.
There we have to stop. Thanks, Ned, for your usual forthright survey of everything that's going on in the world, and we'll check you back again and see how you've done this time. Thanks, too, to our panelists. Hope you'll be back again next week. I won't be. Having single-handedly carried the broad market to all-time highs, and with a full head of steam behind it, I think I'm clearly entitled to take my annual vacation now. It should be safe to leave this chair next week in the hands of my friend and colleague, Carter Randall, who will be talking with the top bond market, Gary Coburn, and will have the responsibility of keeping things moving up across the board. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the financial support of viewers like you and by Prudential Bates Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Wall Street Week with Louis Rukeyser transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.